You're listening to Pre-Market Prep. I'm Brianna Valesky, sitting in for Joel O'Connor with my co-host Dennis Dick. We're joined by Kevin McPartland. He's the principal of market structure and technology at Greenwich Associates. Kevin, thanks so much for joining us on this Friday morning.
Yeah, thanks for having me. Great to be here.
Kevin, let's jump in away from the equity markets for a bit. Most of the time we talk equities on the show, but let's talk the Treasury markets there. And we had a flash crash back a year ago, and we've got the investigative report that was recently released by the regulators. And what did they have to say about this Treasury flash crash?
It was a fascinating report. I've spoken to a number of market participants, and they really did a good job of capturing how the market works. There's a lot of data in there that we had never seen before that helps us understand sort of what role the proprietary trading firms play in the market, which that was of particular interest. In the end, they said there was no smoking gun, which really doesn't surprise me, and there was no concrete explanation. There were some sort of data points that were a little out of the ordinary, not surprisingly, of course. But there were no sort of correlations back to any particular type of activity. So again, I think we know a lot more about the market than we did before the report was produced, but we certainly don't have a definitive answer as to exactly what happened that day.
Kevin, you know what was interesting though? In that report, they didn't use high frequency traders HFT. They used this new acronym, which, surprised a lot of the industry. They used an acronym PTF, which stands for Principal Trading Firm. First, why do you think that they were hesitant to use that HFT acronym, and why this new acronym PTF?
Well, so it goes back to, I think, some conversations that you and I have had over the past several months. Right? High-frequency trading isn't in and of itself a strategy or a firm type, right? It's sort of just explains a little bit about how you're trading. A more common industry term over the last year or two has been PTG, Principal Trading Group. So I think the Treasury sort of went with sort of a slight deviation from that. The point I think they were trying to make here is that these firms aren't all the same. They are very different, in fact, and the report spent quite a bit of time talking about aggressive liquidity and passive liquidity, and showing that even though the top 10, we'll call them PTFs, do the majority of the trading in the Treasury market, the ways that they participate in the market individually are very, very different from one another. So I think that's why they wanted to create this new umbrella term to talk about these firms and really point out that they're not all the same.
It's a great point that you're making there that, high frequency trading isn't actually a strategy in itself. It's just the speed of which you're executing these trades. So it's more just the system, how you're using it there. And it's been a difficult thing, like even to, who is a high frequency trader and what actually defines a high frequency trader. I know in the past they've tried to define it, and it's a very difficult thing to define. Like even I look at our own firm here, Bright Trading, and a lot of times people would say, oh, you guys are high frequency traders. You guys are trading every day. You're using algorithms to trade, you're doing a lot of different things. But then when we look at ourselves, we say, well, we don't really classify those as your typical high frequency trading firm because we're not using co-location, and most of our strategies aren't related to millisecond speed. So, we say, no, we're not high frequency traders. We're not doing that same thing. But really, when you think about it, if you had Warren Buffett and you asked, if you were making, thousands and thousands of trades a day and sending thousands and thousands of orders, he would probably say we're high frequency traders. So it's kind of like perspective there, and it's a very difficult thing to define, isn't it?
It is, yeah. I mean, from what you're explaining to me, right? That's quantitative trading as opposed to Warren Buffett, who's much more fundamental. And one of the other things the report pointed out is that even of the major bank dealers that are part of the market, they showed how all of the firms that are participating on these platforms, on primarily eSpeed and BrokerTec, all use some level of automation. So the days of, a whole desk full of folks sitting there, on the phone, screaming and yelling, trading treasuries, that has passed us. There's certainly a lot of sort of voice interaction between, the investment community and the sell side. It's about 50% electronic by Greenwich's estimates. But again, even those trades are, very much sort of driven by, electronic pricing that both sides can see, and the big broker dealers will look to the interdealer market to figure out how they can help price for the client. So, the market is electronic. It's been electronic for a long time, and quite frankly, given the liquidity and the level of standardization, if I remember, we're talking about U.S. government debt here. The market should be electronic. It's actually very well suited for electronic trading.
Well, and this might be a good segue into the NYSE issues that happened there last week, obviously, because the markets are so electronic here now. What was interesting when we had the outage on the NYSE floor, you still had quotations. NYSE's ARCA venue was still working. You had multiple electronic market making quotations on all of your other exchanges still operated. And quite frankly, here we were looking, even at our own firm and looking, we didn't even notice it, immediately that the NYSE was out because, it doesn't have, nearly the volume and the impact that it did before. And there's still a number of other exchanges, all the other exchanges to trade on there. So electronic trading here, obviously, and even fragmentation here to a certain extent won the day because, that NYSE outage, all the other stocks traded very, very well considering that the floor was down.
Yeah. I mean, the market worked remarkably well. A lot of the algorithms that are used, they're designed to look for issues with exchanges and reroute those orders to like exchanges, right? So we did some analysis into the data, and the rerouting was done to like exchanges. It wasn't the orders weren't rerouted to ATSs or to dark pools, for instance. So they sort of just migrated around primarily, to BATS and to NASDAQ. And so the one interesting bit that we did pull out was the importance of the New York Stock Exchange at the open and the close. And thankfully, they were able to get up before the close, or else, the problems might have been a little bit greater, given how important the closing price is from the New York Stock Exchange. So I think if there's any sort of, like what do we need to know for, in case this happens again, I think the importance of the open and the close is something to keep in mind. But yeah, I mean, generally we agree with you. It was really a great show of how well the markets function and how well the technology helps to keep trading smooth.
Kevin, just go back to that point on the close and why it matters. Is it some of the indexes themselves use the NYSE quotes to calculate the actual closing index prices? Is that correct?
Yeah, and a lot of the mutual funds, right? That's how they'll calculate their NAVs at the end of the day, is based on the NYSE close. And I think if it's sort of NYSE listed stocks, also the close on the NYSE is pretty important to how people mark their books. Which is, and I think I'm sure you've looked at this data, right? But the volume at, where you see real activity on the floor, on the physical floor of the NYSE is at the open and the close, and I think that's really where the floor continues to show its, its helpfulness and its relevance.
Yeah, it's such a price discovery event, bringing buyers and sellers together for the opening print and the closing print there. So that's where maybe a little bit of human, component there really does help still. So I think that's, why the open and the close is so important. And it was very good that, we did function at the open that day and we did function at the close. And maybe it would have been a slightly different story, like you said, if, we wouldn't have got back up before the close here. So, Kevin, what else in market structure world here? And what about, well, let's just talk about, your clients. What are they saying here over the overall markets here? Because we've had, obviously the Greece, thing. It looks like they've kicked the can down the road here again. And I was just arguing, that it seems like the U.S. markets, when I compare them to, the other markets around the world here, are kind of like the best place for money right now because we were looking, at Japan, and, Japan's been a 30-year recession, and China obviously has had, major issues there. They're not even allowing you to short stocks over there right now, which seems crazy. And, Europe, we kicked the can down the road, but they still got issues there. Canada's got problems with oil. Do your clients are they looking at the U.S. markets as potentially maybe the best place for money right now?
Yeah, which is kind of ironic if we look back over the last 7 or 8 years, where I think a lot of folks look to the U.S. as the start of the crisis, right? That we've really stabilized so much. I think it speaks volume to the actions of the government and monetary policy. I say that now. We'll see what that means 10 years from now when we sort of start to work our way out of zero interest rates, and hopefully that won't have a too negative effect on the economy in the long term. But I guess the other thing we always have to remember is obviously this world is very global. Not only do equities trade quickly, but news travels very quickly as well, and the markets can react very, very fast to big news. So I feel like 20 years ago, this kind of action in Greece wouldn't have had such a quick impact on U.S. bond prices or currency or equities for that matter. And now it's just the reactions are very, very swift. Which is good and bad. I guess we can assume that all of the information is priced into the markets pretty quickly. So I think you're right. It feels like the U.S. is a good place to have your money these days, but let's not forget how global the markets are,
Right.
and everybody still needs to sort of have prudent risk management and make sure they're keeping an eye on what's going on in the rest of the world.
Hey, that's a great point, Kevin. We've been on the line with Kevin McPartland. He's the principal of market structure and technology at Greenwich Associates. Kevin, thanks so much for joining us this morning. We really appreciate it, and we'll have to have you back on again soon.
That sounds great. Thanks for having me, and have a great weekend.
Thanks, Kevin.